How are we doing? Okay. How are we doing? How are we doing? This is Dr. Gregory Clark Sr., and it is wonderful to be back with you here for the Comeback Conversations with Dr. Clark. I know we had a little bit of a hiatus, a little bit of a mini break, but we are back and we're going to continue in the discussion tonight around life insurance. Last time we met, we talked about term and whole, and now we're going to get into some variables. We're going to get into some variables. We're going to have a great conversation tonight. And once again, I appreciate the members of the Comeback Collective Circle who are in the building. Now, let's see. I think that Samsung, could that Samsung be Tanya Cooper? Let me see. Let me see if I'm right. So I can name you correctly. I like to interact with people because I know none of us are companies from another country. So who is Samsung? So we can name you properly so we can acknowledge you. And shout out to Mr. Jackson, shout out to Mr. Franklin, shout out, of course, as always, to Miss Johnson in the building. And so who is Samsung? Before we continue on, continue to flow on, you don't have to be a stranger here. We like a dialogue. We like people to be interactive even though the teaching is a teaching, but at the same time, we love to be interactive and make sure everyone is a part of the process. So right now, until that person can, I guess, catch up to what we're doing here, we're going to jump right into the teaching. Not even going to belabor long, which is excellent, which is excellent. And let us see. Let me get my share on. Let me get my share on. And of course, you know, we are blessed and highly favored and flowing accordingly. Okay.
William Richards.
William Richards. Why, hello, Mr. Richards. How are you doing?
Yeah, I'm trying out a new thing tonight. Behave myself wisely in a perfect way.
Okay. That is good. That is good. As I'm waiting. Okay. Let's see. We we are, you
I'm
know.
trying out something tonight, so that's what happened.
No. That's good. That's good. That's good. Just appreciate you from coming all the way from St. Martin to join us this evening. We appreciate you, young man. We appreciate you. And of course, I always ask our moderator in residence, Miss Johnson, if she can see the screen.
Yes, I can.
Amen. Excellent. So tonight we're going to jump right into talking about variable life insurance versus variable universal life. There's some very distinctive parameters that we're jumping into. And why is this so important? Like, as we talked about the last time when we talked about term and whole, people sometimes made the assumption initially when you start getting into life insurance, people are saying you're trying to kill them off. We're talking about life insurance, but technically, all those who are moving in wealthy and affluent spaces recognize, or even some of the rich people, because rich people, that means you started to get a little coin. It was almost like when we think about 50 Cent, when 50 Cent first came out, he was talking about get rich or die trying. And then once he moved from that space of just being rich into moving in wealthy, and now he's pretty much at that affluent stage. Your viewpoint and the way that you move moves a little different. You start to recognize why insurance is so important and it's part of a wealth strategy. So both variable life insurance and variable universal life, VUL, insurance combine investing with life insurance protection. Both let you put your cash value in various investment funds, and your future cash value balance and death benefit depend on this investment performance. So think of it as a whole life plan with some other stuff that it's like the markets can influence what you have left. The markets are doing good, your death benefit will, and your future cash value balance will benefit from it. The markets are not doing so good. You can be another way around, but usually they have some level of, baseline. But, we have to recognize those variable life insurance products are very, very, I won't call them risky, but If you're not risk averse, then a lot of people who are in particular positions and dynamics don't mind doing that because they're just looking for the long-term goal. And they know it's really not necessarily for them, but probably for those that they wish to desire to leave these particular policies for, then they don't mind for the variable movements of it. The key difference is flexibility. Variable life insurance charges the same premium each year.
Dr. Clark,
Yes.
I have a policy I believe is similar to that. They pretty much control the investments of the money, even though it's maturing and you're making your monthly payments as well.
Correct. Usually it's sometimes it could be an insurance company, sometimes it could be even a brokerage house sometimes offer these products to some of their clients. And what it is that since they're already invested in the markets, sometimes people will get this particular type of policy for the fact of the matter is that if the market, especially in bull markets where there's a precipitous growth pattern that's happening, then there's a high probability your cash value and your death benefit will benefit from that. So yes, you may have that type of product unbeknownst to you, and then that is probably definitely one of the variable is either the BLI, which is the variable, or the universal life, which is the BUL. Thanks for that reference point of letting us know what you may have, because that's a good thing. Now, at times like the past couple of weeks, as the markets have been acting funky, hopefully you haven't been looking at your, life insurance if you have a variable universal life. But as I always tell everyone, regardless of whatever you choose to invest in, especially if you're in the markets, don't get caught. If you know that you're in the markets for long term, there's going to be dips. There's going to be buying opportunities. There's going to be times where your stuff is flexing its muscle and you're making a lot of money. That's great. Keep it riding. Or even if you're going to take profit, recognize where you're at, that you're not taking too much profit because you desire for your money to work for you. You shouldn't be just working for their money. After a while, you should be figuring out a percentage of your finances that should be working for you. We have debts, we have responsibilities, and yes, we have bills. But that's where it goes back to being maximizing and being responsible for how we handling the resources in our hands. As we see, even if we was to bring it from a scriptural standpoint, when we see the story in Matthew about 3 talent, the 2 talent, and the 1 talent. See, we're not going to really, so even though the one with the 1 talent got cursed and was told that, they were a terrible servant, but it goes to show you that regardless of wherever you're at, I don't care if it's $25 a week. I don't care if it's $50 a week. I don't care what it is. But you should be putting something away. If we have enough time to go to our favorite coffee shop or go get some fast food, then we have enough herewithal within ourselves to say, come on now, something, $10, $15, $20, $50 a week, something. We got to make that choice. And that's where the difference between people who are on the lower end, then you have your middle class, and then you have those individuals that starting to move in the space of being rich. Then you start moving into the wealthy, and then the affluent. And so we all have choices to see where we're going to be at. And sometimes that particular restraint that we put upon ourselves is not limiting. It's recognizing that you have the ability to use wisdom in all things. So variable universal life insurance lets you change your premium each year as well as your policy death benefit. That's one of the main differences. So if you have a regular variable life insurance, okay, you say that you have $250,000, you send them their payments, okay, they're going to still invest in the market, and maybe your death benefit, depending upon how good that they invested your money, might be more than the $250,000. Whereas in variable universal life insurance, it lets you change the premium each year as well as your policy death benefit. So say you made with variable universal, say you had 200,000, but the next year, maybe you can't afford 200,000. It will actually let you once a year to say, okay, I may have to lower that a little bit. Maybe I can afford 150,000 or 100,000. And then that following year, maybe you're doing better. So no, let's bump that back up to 200. So you have choices. Yeah, variables. That's why that word variable is so important. Remember, think about it from a math stage. I know certain people may not like math, but just think of math like from algebra. That variable or that potential figure or factor is always at play. And allow yourself just to recognize that if you choose to have one of these type of policies in your, how should I say, your portfolio, along with your investments and things of that nature that you're willing to invest in. If this is part of your portfolio, just be mindful of that. As we move on to the next slide, let's see. Okay, definitely. Oh, that okay. What is going on here? Okay, see, let's see. Mercury's in retrograde. I understand. See, you just got to work with it. We just got to work with it. Okay, now let's see. Now they'll be cooking with gas. And I wish to acknowledge Dr. Cheryl Clark is in the building, and also Miss Karen Clark, who happens to double as my sister, there in the building. So desire to make sure I acknowledge y'all. Once again, Miss Johnson, can you read the title and the first paragraph?
Yes, I can. Understanding variable life insurance. How it works. With variable life, you pay a fixed premium that does not change each year. Part of the premium covers your insurance cost, and the rest goes into cash value. You invest your cash value in a selection of investment subaccounts similar to mutual funds.
Now think about that. They give you the option, like once a year, or they'll probably send you, a notice of saying, okay, where would you like us to put your money? So you do have some control in that aspect to say, okay, maybe they may put it in some riskier mutual funds that may be dealing with some high growth or high potential companies. And maybe you may get a higher return because those companies start to accelerate and grow. Okay, that means you're going to have more of an income that's going to benefit your cash value. But at the same time, you do have a choice in the matter, because they'll send you a notice. And usually if you say just keep it rolling, they'll send you the notice. If you don't make any changes, they'll just keep rolling whatever it is that they already have your money working in. As long as you pay your premium, you're going to be good. And now the next paragraph. Your cash value grows tax-free as long as it stays in the life insurance policy. That's another reason why people who start moving in wealthy and affluent spaces start to like these. You can withdraw your cash value while alive, but you would owe income tax for taking out gains above what you paid in premiums. Now think about that. That's like, think of it the same way of having an IRA or any type of other investment retirement account that I'm going to come to you, Ms. Johnson. And you have any of those respective type of accounts and say all of a sudden you're going through a rough patch or you're going through a situation where you feel you have to tap into that. The IRS is already going to have their hand out looking for the 10% penalty. That's not even counting the regular taxes, because now they're going to consider that as income. But most times they're going to say, okay, are you going to pay the 10% now or when you file your taxes at the end of the year? So you got to think about that in terms of, how we structure ourselves. Because then I would suggest, like as we did probably 2 weeks ago in the last conversation, I would tell people then it's better for you keep this type of account. Make sure you have a whole life that has the ability for you to borrow from that and tap that, even though it may lower your death benefit. But if you know that you're going to eventually pay yourself back, then you do that as well. So first we're going to go to Ms. Johnson, and then we're going to go to Ms. Karen Clark. Ms. Johnson, the floor is yours.
Thank you. I'm not familiar with the product. Is it similar to an annuity or no?
It's in the annuity family.
Okay.
It's definitely in the annuity family. Annuities is sort of like that as well. As long as you can stop paying into the annuity, and then annuity is just, okay, whatever you've already circulated into it, the annuity will still grow. It just won't grow as much. But then even when it's time for that annuity to give you the death benefit, it'll say, okay, depending upon what it is that you've invested in the markets or the mutual funds that we invested in, gave you this amount, this is what we collecting the check for. So yeah, In some ways, variable lives are in the annuity family. Very good question.
Okay, thanks.
You're welcome. Miss Clark, Miss Karen Clark.
Hey, how are you? How's everyone?
Everyone's good. Happy
Yeah,
to hear your voice.
yeah. Um, I have a question.
Mm-hmm.
I'm not quite certain about something you just said. So at TDA, when you do,
You talking about tax deferred account?
yes,
Okay.
tax deferred annuity, when
Mm-hmm.
you do withdraw money, there is a penalty plus the taxes?
Well, any IRA, anything that's considered towards for your retirement. The
Yes,
reason why the IRS always puts a penalty is usually at least a 10% penalty. The reason why they do that because they're desiring to disencourage you from tapping into that. Because they're basically saying you're putting this money away for when you're at a time frame when you'll need it when you're older. So
yes.
if you tap into it before, like I know, like some Roth IRAs and things of that nature, sometimes it's like 59 and a half. If you do a withdrawal before then, they're going to charge you that penalty. Now, for some tax deferred accounts or annuities or things of that nature, depending upon whatever the time frame that's stated, that's aligned with the tax laws. It could be 59 and a half. Some could be 62. So if you say you reach those thresholds, now you won't get that penalty because now you hit the time frame where
Oh,
once you hit that time, that once you make those respective dates, like they say, if you have a particular IRA, it's like Roth IRAs is usually 59 and a half. Once you hit 59 and a half years of age and you say, okay, I need $10,000 out of it, the IRS is going to look and says, oh my God, this person's almost 60 years old and they're taking it out of this account. Okay, that's going to lower their benefits that they're going to get in the long term, but we can't give them a penalty because they're tapping into their money past the threshold where we could have charged them a penalty.
oh, so there is a threshold because I was thinking
Mm-hmm.
irrespective.
Mm-hmm.
It could be like after retirement, whenever that time comes. So okay, so
No, no,
then
no. When you at that time frame, we definitely will get into that during the course of the year. But this is a very good question. Once you reach that threshold, it's like Social Security, like how they say these days, people can take Social Security as early as 62, which means you'll get a lower cash benefit. And if you wait till 70, and sometimes now, even how the federal government has moved, they're asking people if you can wait to 72, hopefully even 74, you'll get more money. But they're hoping that even though you're going to get more money because you waited later, even though you hit the threshold at 62, you wait to 74, you're going to probably get the highest that they will have to give you per month, along with, Medicare and Part B and all the other stuff that happens when it's time for you to do that. Even though in this country, 65, they mandate you to get on Medicare. But when it comes to the Social Security part, the later you wait, the more of a monthly check that the system has to give. So now when you look at your tax TDAs or some of these different policies and some of these different cost structures, they usually have something that's built in and say, okay, if you take it at 50, like you start investing at 35 and all of a sudden around age 50, you say, oh my God, I need like $20,000 out of this thing. Okay, there's a way that you can say, yo, I need to pull some of that money out. I've seen that this particular variable life policy has been growing. I need $20,000 right now. Okay. They'll give you the withdrawal, but then the first thing it says, okay, would you like us to do the tax withholding? So you may need 20, you probably may end up with 18.
yeah.
And that's why they always say, talk with your financial advisors. And even though we're not giving financial advice, we're just giving you the raw numbers here. Always seek out and do the research on your own and
Yeah.
make the appropriate benefits and make the right choice for you at the particular time.
Thank you.
You're very welcome, very welcome. And just like it says on the bottom, fixed premium, same payment amount every year. So that means they'll probably say that, okay, if it costs $6,000 to be in this particular policy, they'll break it up, saying $500 a month, pay your premiums over those months. Part of it goes to cover their insurance costs in regards to managing the account and the rest that they're investing. The rest is in the markets. Maybe they're helping to someone get a mortgage. Maybe they're helping someone get a business loan, whatever it is that they do. And hopefully as they generate their returns along with whatever they invest in the respective markets is growing, you start to see the benefit in your cash value. Investment growth, cash value grows tax-free in the policy. That's another benefit of that. It grows tax-free in the policy. And guaranteed minimum is death benefit protected if premiums are paid. So say, God forbid, you're in one of these and say the market starts to tank, but your face value of your death benefit is say 200,000. Say you have a policy for 200,000, and all of a sudden they say your cash value is 180. As long as you haven't borrowed against it, and it's based upon the fact that the market is just not doing as well, they still have to guarantee you that minimum. That's another thing that's good about variable life. They still have the guarantee. So even though they may not have done well in their investments, but the face value of your death benefit, as you've been paying your premiums, you're going to get, whoever is your beneficiary is going to get to see that 200,000. They can't lower it because it's not your fault. The markets went down. So that's just a thought, just to think about that in reference to that. And I see Mr. Guthrie's in the building. So thank you for joining us as well. So variable life insurance advantages. Multiple investment options. You pick between a range of investment funds for your cash value, similar to investing through a brokerage account. It's very clear. You think about, like, if you're sitting there with your financial advisor, he's sitting there, I want to put you in this variable, this mutual fund, I want to put you in this ETF fund, and you start saying, yeah, do it. Okay, so now you're starting to understand, as you send in that insurance money each and every month, part of your money is going into these respective type of vehicles for growth. So you think of it, that's why I said variable life is almost like most brokerage houses do offer this. Your bigger banks and things of that nature, they will offer this to some of their high value clients, because if they already have a brokerage account with them, why not offer them this? And sometimes they even do that to hedge themselves. But that's part of the fact of moving from just rich, wealthy, and affluent. Investments boost benefits. If your investments do well, your cash value and death benefit will increase more quickly versus products like whole life insurance. This is the difference between whole life and variable. It's like an investment account with an insurance product attached to it. But all of a sudden you hit that right bull market, and all of a sudden you find the next stock that goes from $100 to $400, and your stuff is just going crazy. All of a sudden they'll send you a notice like, well, due to your cash value, your face value is 200, but now your cash value is 225. And you're sitting there probably smiling. And you should be smiling. Because as long as you keep paying those premiums, that money is growing tax-free. And I don't care who you are. I don't care if you're at the lower end all the way to affluent. People desire not to pay taxes legally. And this is one of the ways that sometimes some of the people who are at the upper edge of the spectrum, and that's why they don't desire for you to know some of this information, recognize how can a person way up there pay less taxes than somebody that they hired? Because they have more write-offs, and they have the right people who know what to put their money in and allow them to work everything the system has allowed them to work. And that's why we're going through this dynasty path this whole entire year. Premium stability. You pay the same premium the entire time. No need to worry about cost increases later in life. So that means they're not going to come to you and say, oh, you got to pay more. No. If you have that face value and you was able to get it young enough and wise enough, that's why I would say most individuals, I would say people who are 30 years or younger should end up with variable lives and whole life plans. As much as they would say, oh, term life is less expensive and this and that, that's good. That's true. And you can get a higher level. Oh, that's nice. But there's something about having those plans where if you have the option to be able to say, you know what, I need to tap into something, and I don't need to go to a bank and start paying their interest. I can literally say, you know what, I'm going to borrow against my death benefit because I have some cash value, and then make the choice to say, you know, I'm going to pay myself back. Like, okay, here's my monthly premium here because I took out a loan or I took some money out of my cash value here. I'm paying myself back. And that's how sometimes you're actually helping yourself. You borrowed against yourself. That means you're almost starting to move like a bank. Just something to think about. And guaranteed minimum death benefit. Most policies offer a guaranteed minimum death benefit so long as you continue paying the premiums. So we wanted to make sure, desired to make sure that this was clear so we understand how variable life insurance works. Any questions before we move on? Excellent. Variable life insurance disadvantages. Yes, there can be some disadvantages. Yes, there can be. Higher costs. More expensive than standard life insurance due to administration and investment management fees. That's what I said. Most times that you see people who have these type of insurance policies usually are coming along with the fact that if they have a high net worth and they already have a high balance brokerage account, that brokerage firm will offer them this product. Other than probably other insurance companies as well, if they see that they have a particular high net worth, like, okay, we see that you're into the markets and stuff like that, and you're willing to have some risk here. Here's this product where, you know what you're circulating each month, but then there's a high probability as things go. They say the S&P has averaged over the 50 years somewhere between 6 and 10% per year. Some years a little higher, some years a little lower, but average is usually that 6 to 10% range. That's a good, decent level of growth, even in down markets or bear markets. So usually, just you have to think about it, there are higher costs for variable life insurance. Market risk, death benefit, and cash value can decrease if investments perform poorly. Everything in life is a risk. If you're willing to roll the gamble on one of these policies, but you got like 2 or 3 others that are working as well, okay. It's not that you were a bad steward over your money. You went for a particular policy that you recognized and understood the risk. You came in there with your eyes wide open. You did your research. You don't just go in there and just say, oh, we're just putting you in this, that, and the third, and you have no idea of it. Please, there's too much technology today that there's no reason why you can't be aware. We cannot play that game about I don't know, or I'm just ignorant of it, or I don't understand. No. Then understand. For some of us who know a particular, some of the tools that we use, you can even say, yo, break this, all this stuff that they gave me in a contract in a 5th grade level. So I understand if you need it broken down even that level. And it's not disrespecting anyone's cognitive ability, but just so the fact of the matter is, we cannot go into spaces no more and saying that we don't know. Or, that expert told me. You're the expert, tell me. And as you're telling me, I'm breaking down this information so I understand what I'm getting myself into. Instead of those time frames where we used to move where, whatever the person said, that's what we do. No, you in space now to know exactly what they're saying. So they're not trying to talk circles around you. Limited flexibility. Cannot change monthly premium or adjust death benefit yourself. You can't do it. Not with variable life. Now, more probably when it gets to universal, you have some leeway. But for variable life insurance, no. You got in at a certain age. It is what it is. It's not what it's not. It's an investment vehicle. Hopefully you put it in the right investment, mutual funds, ETF funds, stock funds. Boom. And your death benefit stays stable, and hopefully your cash value grows. If your cash value grows, they're gonna have to give you the extra. And surrender charges. Fees apply for withdrawing cash or canceling before surrender period ends, often 10 to 15 years. So usually people who end up with these type of policies are usually a high net worth individuals who already know I'm going to be in this thing for at least 10 to 15 years. The same way that I talk about if you're going to be in any markets where you're willing to invest your funds, you're not willing to give at least 5 years and to be able to go through the dips. And sometimes when a dip happens, like, wait a minute, I got some extra cash here. Let me go, bargain shop. I made a post sometime last week. It says the wise bargain shop. They'll make you feel a way that you look for a bargain. That's how the rich stay rich. Like past couple of days, especially towards the end of last week, when the market was going crazy and, certain stocks and things were going down, there was some high buying happening. Because people were like, yo, I got some liquidity. Let me put my money back in the market, catch some of these bargains. Because if they start moving up like how some of them starting to move over the past 2 or 3 days, that means my money's growing. Whereas people try to put you in that scarecrow factor and keep you away from the markets. This is, I don't care where you start at, start. I don't care how old you are, start today. Make the choice, do your research. Sometimes start looking in your house. And I've said this before, look in your house. What do you circulate your dollars on? Wait a minute, this company is a public company. Well, if you buying their stuff,